Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
Welcome to The Explainer. Today, we're going to break down the advanced tax strategies that savvy real estate investors use to build some serious wealth. We're talking about turning tax obligations into really powerful investment tools.
You know, for most people, taxes are the single biggest drag on investment returns. But when it comes to real estate, there's a whole playbook that completely changes the game. It starts with a pretty powerful strategy you can use the entire time you own a property.
Okay, so this first play is all about creating massive paper losses. Now, these are not real cash losses. Don't worry. They're strategic deductions you can use to offset your other income. And the cornerstone of this whole strategy is a concept called depreciation. The government basically says, hey, we get it, your building has wear and tear over time, so we'll let you deduct a piece of its cost each year to account for that. And the best part, like the slide says, it's a non-cash expense. You're getting a real tax deduction without actually spending any new money. It's fantastic. But here's the problem. Standard depreciation is incredibly slow. The IRS makes you spread that deduction over 27.5 years for a residential property. But what if you could say, hold on, IRS, the carpet and the appliances in my rental aren't going to last 27.5 years. Let me write them off faster.
Well, that's exactly what a strategy called cost segregation lets you do. It's basically an engineering study that unbundles the property, right? It separates the things that wear out fast, like the carpet, light fixtures, and appliances, from the parts of the building that last a long, long time.
Okay, let's make this real. Imagine you buy a $500,000 investment property. A cost segregation study comes back and finds that 150 grand of its value is actually tied up in stuff that has a much shorter 5-year useful life.
In this chart, wow, it really shows you the power of this. With the standard method, your first-year deduction is tiny, only about $5,500. With cost segregation, that jumps to $30,000. But then you layer on this special rule called bonus depreciation, which lets you immediately write off a huge chunk of certain assets, and the results are just staggering.
Your first-year deduction just explodes to $120,000. That is a massive paper loss that you can then use to offset other income, maybe from your job or another business. We're talking about slashing your overall tax bill for the year by tens of thousands of dollars. Okay, so you've generated huge tax savings while you own the property. That's great. But what happens when it goes up in value and you decide you want to sell? Well, that brings us to the second play in our book, the tax-free swap.
This is the famous 1031 exchange. At its core, it's just a really powerful tool in the tax code that lets you sell an investment property, take all the money, your profits included, and roll it all into a new, like-kind property. And by doing that, you legally get to postpone paying 100% of the capital gains tax.
Now, the process itself has some very strict rules and timelines. After you sell your place, you only have 45 days to formally identify potential replacements, and then you have to close on the new property within 180 days from that original sale. But here's a super important question. Is it always 100% tax deferred? And the answer is no. There are a couple of really common traps, mostly related to cash and debt, that can actually make part of your gain taxable right away. So as you can see here, there are two key rules you got to follow. To defer all the tax, you have to reinvest all your cash, and you have to take on equal or greater debt. If you keep any cash out of the deal, which the IRS calls boot, that cash gets taxed. And in the same way, if your new mortgage is smaller than your old one, that debt relief is also treated like a taxable gain. So this is where it gets really, really interesting. These two strategies we talked about, cost segregation and 1031 exchanges, they aren't just one-off tricks. They actually fit together perfectly to create this powerful, repeating cycle for building wealth.
Yeah, this is where you go from just saving a little tax one year to creating a true engine for compounding your net worth. It's a whole system for growing a real estate portfolio while keeping that tax drag to a minimum every single step of the way.
So here's how the cycle works. First, you buy an investment property, and right away, you do a cost segregation study. Boom! Huge upfront tax deductions. Second, after the property goes up in value, you sell it and use a 1031 exchange to defer all those capital gains. Third, you take all of those untaxed profits and you level up to a bigger, better property. And finally, you just repeat the cycle over and over and over again.
Now you might be thinking, well, aren't I just kicking the tax can down the road? Not really. Deferring tax is a massive win because you get to reinvest money that you would have otherwise just paid to the government.
It's basically an interest-free loan. But even better than that, there is an incredible endgame to this entire strategy.
It's called the step up in basis. If you continue this cycle and you hold on to your properties until you pass away, your heirs get to inherit them at their fair market value on that day. Their cost basis gets stepped up, and all of those capital gains you deferred over your entire life, they can be completely and legally wiped out, gone.
All right, before you run off to start executing this playbook, it is absolutely vital to understand that these are advanced strategies. They're governed by very, very complex rules. This is not something you should try on your own.
The complexities are pretty significant. For instance, some states have clawback rules if you exchange property across state lines. The rules are different for foreign properties. And things get even more complicated if you try to convert your personal home into a rental or hold the property inside a trust. So the bottom line is simple. This is not a do-it-yourself project. You absolutely must talk to a qualified professional.
So, the ultimate takeaway here is this. Real estate offers a playbook that goes way beyond just hoping for appreciation. By mastering strategies like cost segregation and 1031 exchanges, you can literally transform your tax bill from your biggest liability into one of your most powerful tools for building wealth. So the only question left is, how are you going to use it?